Markets started to show some cracks on Thursday with a number of AI-related stocks losing their 20-day simple moving averages. The last time Micron failed the 20-day, it fell nearly 25%. And we know that Meta not only admitted to overbuilding infrastructure, they also said yesterday that agentic AI was not moving at the pace they expected it to. But what not many people are watching is this Kospi, which of course is basically SK Hynix and Samsung, aka the memory trade. Notice on Friday, while US markets were closed, this produced almost a bullish engulfer at the 50-day. Reclaim 8200 and Korea saves the day. Reject 8200 and, well, use your imagination. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly timescale now that the June bars have officially closed out. What do we see in terms of candle structure and location? Second bar in is a red-bodied hammer, which does tell us that the buyers stepped up towards the range lows for the month. They were able to push prices back up towards the upper third of the monthly range and close there, which is pretty decent, not bad. But it is a red-bodied bar, of course, which means that the candle close is technically underneath the opening print. Maybe the sellers made slight progress if you compare to the previous monthly close, but I mean, how much progress are we really talking about here? This is mostly equal highs on the bar-to-bar location count, mostly equal lows, a slightly higher low if you want to split hairs with me. It's an inside bar. It's a bullish 3-bar play at the monthly highest high. It's all-time highs. I mean, how bearish could this really be? It looks bullish for a potential Brigade bolt out of the 3-bar play and offering continuation. Even if the market pulls back, let's just walk through the exercise as we typically do. This is the highest high in the trend count, which means if the market pulls back, it can offer a higher low. And where would be the ideal higher low? It would just be over the previous all-time high retest at 700. So if the monthly chart were to look something like this, back up to the equal high, consolidate, and then go up and out, great. The monthly trend remains in the upward direction. Once again, the bullish 3-bar play here at face value would just indicate that this is a possibility as well for straight up continuation. This is not going to be anything new because we look at it on the weekly chart almost every single Saturday, but if we drop in a Fibonacci pull from the major low up to the high, you can see all of this is happening over the Fib 38.2. The monthly wick is above that level, and not that this is going to offer much use as of right now, but there's a quick comment here I would like to make. If the market does break out, this Fib 38.2 over time will start to coincide and offer better confluence with the previous all-time high retest at 700, which is just something to have in the back pocket. As well as, again, if we do break out, the monthly 20 SMA will slowly start to creep up and offer confluence at that 700. It doesn't have to happen next month. It's not going to happen next month, as a matter of fact, but it could happen over the next handful of months, and that would just reinforce that 700. Let's zoom out, as we typically do on monthly timescales, and just also talk about if really bad things are going to happen in the market. And every single time we have a monthly close, we talk about this, right? It's a great reminder. You need to see the monthly trend flip to down. Here's the dot-com bubble bursting. There's your double top. Here is your monthly lower high underneath the 20 SMA. Here's your lower low. We're in a monthly downtrend. Whoosh and whoosh. The big capitulation into the lows. If we go look at the great financial crisis, here is your monthly double top, 1 and 2. Here's your neckline. Here is your lower high underneath the monthly 20 SMA. Here is your lower low, and then there's the whoosh, right? There's your big capitulation. If we go compare this to what we're working with now on the monthly time scale, it's just not even close. I mean, you can't even have that conversation yet. So what we should be talking about is like, what is the implied move to the upside? There's a couple of bull flags here that I want to talk about. If we come in here from, let's just zoom out a little bit further, the sickness low to this high, to this pullback low, what I want to reinforce is that the market did respect the 100% extension. Okay, great. Let's come in here from this major low to this high and this low, and lo and behold, where are we? At the 100% extension, right? So that is pretty bullish. What if the market is going to go this for the next bull flag? Where does that bring us in terms of extension? About 850. I'm not saying that we need to go to 850 in the coming months worth of trade. I'm just saying if the market continues higher, would it be reasonable based on the 2 fib extensions I literally just showed you? Would it be reasonable for the market to slow down towards 850 as the next monthly target? I think the answer is yes. Again, it doesn't have to go there immediately next month in July, heck, even August, September. But if we find ourselves at 850 and the market's slowing down, hey, that's reasonable from an extension perspective. Let's drop this thing down to a weekly chart where, speaking of extensions, I do want to share the monthly expected moves for July. This was pulled before the close of Thursday. This was actually pulled on the close of June. So these are the accurate July levels. This is 772.95 on the upper bound and 720.59. In terms of the overall trend count, what would that suggest? Either a breakout of this weekly bull flag to get to the upper bound of the yearly expected move up there at 784, or if we pull back back, we're still in the neighborhood of the weekly 20 SMA. We're still in the neighborhood of that 712 spot, which we'll talk about on the daily chart in just a moment as well. We're in the neighborhood of preserving trends across all time frames. July's monthly expected move does not suggest, oh my goodness, the trend is going to flip to down and it's game over for markets. So that is your expected move. Let's drop in the clean drawing set. Let's get a little bit more granular with the weekly candle analysis. In terms of candle structure, it's a solid green-bodied bar, a little bit more of an upper wick than what would be, optimally bullish, but nonetheless, still a nice green close there. In terms of candle location, you've got a substantial higher low and mostly an equal high. Again, if you want to split hairs with me, it's a slightly higher high, but for the most part, inside bar in the upper half of, or even upper half of the previous weekly range. So in my view, buyers actually go 2 for 2 on the weekly structure and location count. We know that all of this, of course, is happening over the Fib 38.2. We just literally pulled this on the monthly chart as well. We're all set from that perspective. We're over the weekly 20 SMA. I mean, there's really nothing, incredibly new to glean from this weekly chart. We're just in high tight consolidation. Here is the anchored VWAP set. We did close. This is new. We've seen it on hourly charts, but I've anchored it on the weekly as well. We've closed over the all-time high anchored VWAP. That's a decent indication for higher. Once again, this to me simply looks like a weekly high tight flag. We've got ourselves 5-7 weeks of consolidation that are starting to brew. If we break out of this, the measured move is substantial, right? As we've just made mention of. Let's drop in the volume profile on the weekly chart just to point out that the market did support, if I do something that looks like this, over the lower bound of the high volume node up here at all-time highs. That once again is a slightly more bullish indication. Let's drop into the daily timescales now, and let's firstly evaluate this week's expected move. So not the monthly expected move, but the weekly expected move. It's this gray shaded area right here. If you're not familiar with the study on how to set this stuff up, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 755.41. That, of course, would imply a higher high versus last week's high, but mostly an equal high to this area in here. If we're contained by the lower bound, it's 734.15 from the rebalance low. That is absolutely a higher low, but I would even start to look into this one and this one in here, a slightly higher low versus the low of Monday from last week. So expected move does strike me as being slightly more bullish than bearish. We're still neutral. It's not like it's suggesting a breakout into blue sky territories. We're still inside of that weekly balance range in here. Nonetheless, I do find that the daily chart made some substantial improvements into the end of last week, primarily centering around the gap analysis that we conducted on Wednesday. Remember, if the sellers were going to do something meaningful, we'll just quickly recap this. On Monday, they needed to lose the 50, show the lower high, and then get into the weekly equal low back here. Let's just write this one off for now. That's underneath 732. That just simply didn't happen. The sellers could have gone for a look into the gap that failed, lose the key levels, you're back lower. Simply didn't happen. You could have gone for a gap fill reversal, lower high underneath 739.65. That also didn't happen. And as a matter of fact, on that Thursday session, right, you could see right here in the lower wick of Thursday, where did buyers support? Right over the 3-day equal highs, which was the closure of the gap, or at least the retest of the closure of the gap at this point, near the daily 20 SMA. We broke through the upper bound of last week's expected move, and therefore it's not unreasonable that the market may just start to balance in this neighborhood. Generally speaking, I thought Thursday's bar, although maybe painful in select spots for the market, look at your MU, look at your Tesla, look at your Intel, painful for the AI side of the market. I mean, what's pulling the weight? Look at your financials, right? Up 3.58% on the week, really, really constructive there. And as we know, the S&P, it does have financial representation. It will get to experience the benefits of rotation versus your NASDAQ, which will not. So if you're looking for a market that's going to remain more resilient, you're probably looking at the S&P and less so the NASDAQ. We'll still talk NASDAQ, of course. We'll still look into what the tech trade is doing, but the S&P should be more resilient here, and it certainly looks that way as of Thursday's close on the daily chart. So simply put, going forward, what we're looking for here is a confident trend reversal on the daily back to up. What would that imply? We either need to hold this as a new daily higher low in the neighborhood of the 20 SMA and the 50 SMA. We can't really afford to see prices back below 739.65. Consolidation here, or let me just try to draw that a little bit more cleanly. If you test this and can hold it, get back above 743.50, I would still use these two key levels as the arbiters of price into next week, right? It's the start and finish of the gap from that Tuesday Kospi blowup. 743.50 reclaims, I would look for the equal high. And then simply put, just watch for your grind and continuation, especially if it's a rotation trade. It's not going to be like straight up momentum if we're not led by a rebound in tech. If it's a rotation trade, if tech is lagging, if comms are lagging, if discretionary is lagging, and financials and healthcare are pulling the weight for the S&P, it's not going to be a momentum trade. It's going to be a grind to the upside, or it's just going to be a grind sideways. Where things really start to deteriorate is if they sell the tech trade again, as well as financials. If everything's pulling back, then guess what? I would definitely acknowledge that. I was going to say admit. There's nothing to admit. It's an acknowledgement. I would say, yeah, underneath 739.65 with bear flag consolidation here after another lower high in the daily trend count puts the pressure on. A loss of 732 is bearish, right? That's where the bears step up. But as of right now, and as we've talked about on the Wednesday analysis, as we literally just walked through again, the sellers could not get the job done. On Thursday, we did see support off the key level that needed to hold. And as of right now, location in terms of where we closed was bullish on Thursday. Let's drop this thing down into the hourly time scale. Let's get a little bit more granular here. Once again, just look no further than the price action on Tuesday. If you're a bear, you need to see rejections in here near the 20, near the gap close. And it just didn't happen. Like a hot knife through butter, we're just up and away. Now, is the hourly trend up? I would certainly argue yes. You've got yourself a previous area of resistance. I know this sounds like a broken record, but previous resistance acting as newfound support, as long as that can hold in there for an hourly higher low, which is going to subsequently turn into a possible daily higher low, consolidation here, and then you're just walking up the levels. So I would really try to keep it simple into the coming weeks worth of trade for something that looks like that. If things are going to deteriorate, how does the hourly trend flip to down? Maybe you reject in this neighborhood, you get back down into the equal low, and once again, fairly straightforward, just a failure back down into this range. When I say range, I'm talking about this box back here. That, of course, becomes more of a bearish tail under 739.65. So the levels are incredibly straightforward, I would say, as of right now, thanks to just the gap structure and the way that that's played out so far. If we break out a Fibonacci from the low to the high of this move, I mean, we supported in the neighborhood of the Fib 38.2. I'd say the 50% retracement reinforcing the top of the range. Somewhat interesting there at 739.65. And we can come in here with our anchored VWAPs as well. From an intraday perspective, notice the reclaim of the entire stack and the potential for a higher low above it. That does strike me as being more bullish than it is bearish. Let's take this thing over into our market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. Do we have buyers or sellers in control here? I mean, I'm looking for anything that's overly bearish. I don't see it. Even on the pullback day from that Thursday session, shortened week, recording on a Friday, even on the pullback, look at the volume flows into the close. Really strong stuff there. The advanced decline line opens strong. It fades off towards zero, but it's not even close to trend lower zone. The index score is more so flat than it is bearish, and we had a bullish start to the week, right? That looks pretty good. And even the cumulative build with the, sell naturally through the day, how much at the exchange level actually pressed lower? Not all that much. We're typically looking for a substantial read at negative 5,000. The print into the end of day on Thursday right here, negative 1250, not even halfway there to a substantial bearish impression. So I know I said it on Wednesday and I'll say it again. I've got a slightly more bullish bias towards this market right now, as long as we're over what I would consider just the major line in the sand at 739.65. Let's take this over to our market profile, specifically for our ES futures. If you're not familiar with the ES futures on a market profile view, check out the video tutorial in the top right hand corner. I'll give some credit here. This is probably one of the more bearish charts that we've looked at so far, and it's just because the value area does shift lower on that Thursday session. You can see here value was higher, value was higher. We traded higher in the early stages of that Thursday session, but value could not sustain in an elevated position, and instead value is overlapping to down. A slightly more bearish indication, but is this the end of the world? No. If anything, anybody who's bought in this phase through here is more likely to be comfortable about the position should we open higher over value area high on the Monday session. So one of the pathing ideas I can already envision for Monday before we show back up to the office is if we open over value on the top side, we have bullish buffer. Any pullbacks over like 75.50, I'm just rounding here, 75.50 will set up for a move back to Thursday's high and possibly continuation higher. If we drop that level, okay, maybe the bears have a little bit more to lean on. Maybe we grind through here and it becomes more dangerous where? Underneath the Thursday low, which is exactly the previous highs we just talked about on the S&P 500. So I think a very straightforward chart. I love the way that this value developed. I like that in the sort of shortened holiday session here. Futures, I guess, open until probably 1 p.m. as they usually are on a holiday session. They're elevated, right? It's not like we just closed, where was the close there? If I zoom in for the arrow, I see if I can even find it. There it is. It's not like we closed here and then, fizzled out and all on the Friday session we're in here. It's just not the case. So anyways, let's get off this market profile. A little bit of a poor high, a little bit of a poor low on the Thursday session, excuse me. But let's get back on over to business and talk about the NASDAQ. Let's jump this thing up to a monthly chart. Let's go ahead and throw on our moving averages. A simple drawing set will do, and we'll take a peek at the NASDAQ. Here we go. NASDAQ with a clean drawing set. There it is. All right, so monthly structure, very similar. This one has even less of a candle body. You can clearly see you're just dealing with, you could call that dragonfly doji if you'd like. I'm not a big believer in the idea of hanging men candles. You could say that, oh no, this is a hanging man and it's got to be lower from here. And like that was a hanging man and it was slightly lower from there. We just take candles at face value here at the Trade Brigade. It means that the buyer stepped up towards the lows of the monthly range. Same thing, push prices higher, basically closed right at the opening print. Not much of a difference there. And certainly in the upper third of the June range. In terms of location, still bullish towards the highs, mostly an inside bar, very slight higher high if you really want to split hairs. Generally, same commentary as the S&P 500. This is the highest high of the trend count. If it pulls back, we could afford to set a higher low over roughly this 638s on the Qs, excuse me, and really have no problem from a monthly trend perspective, right? Something that looks like that and continues, something that looks like this and continues is no problem. We know that the tech side of the trade is coming under more fire than the S&P because of the lack of rotation and once again, that financial representation over here. So if the market pulls back on the Qs, what would be the key watch? Just watch June's low. It's really that simple. If you crack June's low, you should probably retarget these highs from back here. That'd be one heck of a move in terms of a pullback. What would that represent just in the month of July? If we were to make that entire move there, that's down about 12%. Remember, the market really only has maybe a handful of 10% corrections through the year, and that would be certainly interesting should it align with the previous all-time high towards that 638. So that is your monthly analysis. We could slap a fib on it because why not? We've been doing it. There it is. Over the fib 38.2, no problem from there as this continues to make a new high. Is this confluence yet? Not quite, but once again, if we make a new high and we've got to pull that higher, 38.2 will be confluence with this particular level there. Let's zoom out on this and go take a look at some measured moves. .com bubble bursting, great financial crisis, same double topping action off to the left, but I do want to talk about this first as our measured moves. Let's pull that in over there. This came into the upper bound, kind of just jumped around in there and then went forward. So, it kind of aligned. How about if we go from here for a monthly bull flag? Same area, same neighborhood. How about if we come from here on the monthly bull flag, went to it, kind of noodle around it. So your measured move, if this is going to be this to this to this, is still slightly above us at roughly, let's call that 800 for round number's sake. You could say 790 in the neighborhood of that zone. If we get a monthly breakout, would the market be reasonable for slowing down towards that area? I don't think that's unreasonable. So the answer is yes. The market would be reasonable if it slowed down in that neighborhood. Let's drop this thing down to a weekly. Let's take a look at our monthly expected moves on the weekly chart. There we go. You could certainly see your upper bound is way up there, 779.58 on the NAS, and the lower bound for July is 693.22. This is interesting considering that we're almost there. We're almost already at the lower bound of the monthly expected move. If we're thinking about the candle structure versus the S&P 500, clearly much different. And once again, I think this should be fairly obvious because of the financial rotation there. But an inside inverted hammer, this looks bearish to me. In terms of candle structure, sellers step up in the upper wick, push prices back lower, weak close in the lower third, and it's an inside bar. So all it's really going to take here is a break of the inside candle low, and the door is open at least to this low. If not, heck, if you break June's low and do something along these lines, would it be unreasonable to come into the previous all-time high retest? Well, we just talked about that on the monthly. The answer is no. So it's possible, especially if the AI trade comes completely unraveled, but I don't know that it'd be calling for a huge crash based on the monthly trend still remaining in the upward direction with the opportunity for a higher low, right? So we'll have to start breaking out the mole thesis, right? Monthly, higher low, the mole thesis, if we were to come back down towards that area. Again, let's not talk about it yet until there's actually a breach of the June low. Let's go ahead and take out some fibs just to see where this aligns. Oops, let's get the pull here. There we go. Fib 38.2, kind of a no man's land here. 675s would be an interesting round figure. Maybe the weekly 20 SMA slowly catches up, not this week, but maybe next or even the week after that, depending on where ultimately we land. If we break out the anchored VWAPs on the NASDAQ weekly, you can see the difference here clearly. We closed underneath the all-time high anchored VWAP from a weekly perspective. That is, again, not the end of the world, but if the market's going to be weak somewhere, it's definitely the NASDAQ. It's not the S&P 500. Let's take out the volume profile on a weekly. Let's just quickly jump into our lower bound of the high volume nodes. It's kind of right there. Again, breaking the inside bar low. I'm definitely a bit more open-minded to a NASDAQ washout than I am an S&P 500. If the NASDAQ is washing out, again, probably don't expect S&P higher, but just expect it to be more resilient and possibly grindy and sideways as opposed to just straight down, right? That's assuming that financials still have a bid beneath them, as well as healthcare still getting a bid beneath it. Let's go from the NASDAQ weekly chart to the NASDAQ daily chart here. Let's get a little bit more granular, shall we? Let's take a look at the weekly expected move. It's this gray shaded area right here. We've already shown you the tutorial. Upper bound 733.79, technically a lower high against last week's high. No good there. And certainly the lower bound 691.41 is going to imply a lower low. Not a great look as we expected move. It's just bearish, right? It would imply a trend continuation move or the threat of trend continuation to the downside. I would say the trend here on the NASDAQ is non-existent, right? You have highs, you have lower highs, you have lower highs, you have lows, you have some semblance of higher lows. You're trying, for dear life to hang on to the daily 50 SMA. You could clearly see the difference in the gap analysis here on the NASDAQ. Do something that looks like this. The market did a great job of moving through the gap, but what happened on Friday? Well, your inside bar low gets swept, and instead of saying, hey, we're supporting over 722 and we look like this, back to highs, yikes, you get the close underneath, you're at the daily 50, you're at the daily 50 after a first test off of a daily lower high. I mean, the ingredients to me say any lower high rally attempts early this week, do something like this, the door is open for lower, under the 50, then you breach 699.700, you're talking about the gap close, if not deeper, towards that 675, that's the Fib 38.2 that we just pulled on the weekly, and really your structured breakout level is 664.50. So I can envision the breakdown here on the weekly chart coming from that inside bar low breakdown in here, that's 707, on the breach of, or just the fact of 722 not offering support into the end of last week. Now, I don't want to get overly bearish just yet. I think the setup is there underneath 707, but if this market rallies and rips back up through 722, we talked about that Kospi getting a little bit of a bid on the Friday session. If memory is going to be saved and we get some kind of a retracement that looks like that, that's the bull argument. The bull argument is that the 50 is going to remain strong. We get back over 722. The range continues to compress and we're just balanced, right? And we say, okay, we're going to let this be until the wedge breaks one direction or another. And we just hold our breath until the market gives us the answer, right? That is the alternative take at 722 if it can be reclaimed. Let's take this thing down to an hourly chart. There we go. Once again, clear divergence. You could see it so obviously. Is this an hourly uptrend anymore? The answer is no. If this was going to be an hourly uptrend, you needed to set the higher low over the top end of the range. It just simply didn't happen. So therefore, the hourly trend could easily flip to down on a rally through here, set the lower high under 722. Dare I start to call this the head and shoulders, Kevin? I mean, we're underneath 707 and the door is open. It's there. I can certainly see it in the NASDAQ. I can see it 100%. So with the Kospi rally, I would assume maybe a slightly higher open here into early next week. If the market struggles at 722, that is your answer. If we set a lower high here, that is your answer. If the market says, no problem, I'm here, guess what? Bullish consolidation. We'll see if we can't break the upper bound of the resistance trend line. I'm not a big fan of trend lines. You guys know this, but something that looks like that would be the next follow-up, right? If the market proves to us it has strength back over 722, but with the divergence, I would say here that if you want shorts, pick on the NASDAQ. If you want longs, go to the S&P 500 because it's more well-rounded and we know our up and down levels. Let's hit this thing with some anchored VWAPs. From an intraday perspective, you could see we have given up the entirety of the stack, and as of right now, on counter trend rallies, that would be nice confluence for a potential lower high. So you could see the problems. Again, I'm not trying to be a bear for the sake of being a bear, but the AI trade is under fire here with the Zuckerberg comments, with the overbuilding. You saw it in NBIS, you saw it in the semis, you saw it in memory, right? So you're underneath your Fib 38.2, that's not a good look. You're underneath the Fib 61.8, that's not a good look. And once again, rally rejections of this key structure above sets you your hourly head and shoulders, lower high, and the trend pressure is on for a break of the weekly equal lows at 707. Enough on this NASDAQ hourly chart. Let's jump on into our NASDAQ side of the market internals. Are they bearish? Do they support the breakdown of this market? A little bit more bearish in terms of volume flows on Thursday, of course. The AD line crashing through the zero mark, and the cumulative build, although not substantial, and also not halfway to substantial. Remember, it's 6,000 on the NASDAQ side. It's a bit more of a bigger build than what we had on the S&P. In the after hours here, or in the shortened session from this Friday holiday, you can see we're just middled in that range. So is it the end of the world? Again, I think the first idea here is neutral until proven otherwise with a bearish flavor under 722 rejections. If we reclaim that neutral, like not sure, not convinced, and then sort of like firming up over 722 is better. It's really kind of a wait and see game here on this NASDAQ, right? If you're a trend follower, just understand that the market's not trending. It's that simple. As I'm grasping at straws here to tell you my thoughts on the NASDAQ, I just go back to my default, which is I am a trend trader. I like trading clean trends. This is a series of lower highs, and this is a series of higher lows, which means that there is no definitive trend. And until we get a definitive trend, maybe there's just less to do, right? That's the NASDAQ interpretation. Let's jump on into the NQ on, and also keep in mind, the monthly chart looks great. The weekly chart looks a little, gross. And maybe, let me just go back here for a second. If the weekly chart gets cleaned up underneath this low, let's just say we wick the 707, boom, failed breakdown, and then we're here. Yeah, I mean, if we look below and fail this level and sellers cannot materialize underneath 700, then yeah, I would probably say that failed breakdown, if it does occur in here, would be a bullish, reason to read into the market. A reclaim and a remount to the daily 50 could be your bullish higher low to start to attack back in the upward direction. You might have risk reward longs for something that looks like that. I mean, really, when the market balances, and I catch myself when I'm doing these video analysis, commentaries, I catch myself and I'm like, geez, people are just going to say like, oh, he's saying the market could do whatever it does. I mean, go back to any other period when the market's been in a balanced range. I say the same thing every single time because the market needs to tell us what to do next, right? And so this risk reward does make sense to me if there's a failed breakdown, like literally being open-minded to many different outcomes here on this NASDAQ is, I think, the key objective, right? So let's go back to this market profile. You can certainly see the deterioration of value happening in here. You can see value area on the Thursday session. Here it is on Friday's futures abbreviated session. Again, I can envision the pathing where if we open over value area high, is there a thin structure retracement through this where there's not a lot of volume to pull up and fight through? Certainly. If the market just goes look above and fail back into the value area for a value area rotation, is that also a potential short for a grind through there? Be my guest. That doesn't, that's fine. That is absolutely fine here on the NASDAQ, and I would not be all that concerned about the market. So it's really just about knowing the setups, and maybe that's where I should focus on spending the most time. It's like, if this is look above and fail, then your short is here, right? That way you could short risk reward for the value area rotation with hopefully a tight stop. If the market opens above value area high, just to sort of walk through some of these things, if you open above it and you pull back into it and you find buyers there, again, you're not just resting limit orders, but you see the structure for bulls there, your risk reward is then this, back in the upward direction, right? If the market opens in range and we just say, okay, P for patience on a pedestal because we're in range in value, then the idea becomes, do we just break below previous day low and come back into range for this? That's your long risk reward, right? Like that you can trade that, or is it just a lower high underneath? In which case, great, the weekly chart's breaking down. So those are the things I would be thinking about. Maybe that's on me for taking so long to get to this point on the market profile analysis, and maybe a bunch of people have tuned out by now and they're missing it, but that's it. Let's jump back on over to the platform here. Let's get on over to the Rusty Russell. Let's see what's going on from this perspective. Monthly charts, let's jump into them. Let's see what's going on with our Russell monthly. Let's throw on that 20 SMA. There we go. Okay, so over here, I mean, this looks great. This monthly bar is much stronger than the others. It certainly closes smack on the highs. It's a green monthly bar for that sake. It, of course, sets a monthly higher low and a monthly higher high. It's much more bullish over on small caps, right? And this, to me, is interesting because the market's kind of trying to figure out what Warsh is going to do about rates here. I don't think we'd have small caps ripping higher if ultimately participants believed we were going to get 2 rate hikes. So the monthly look on this Russell is constructive in my view for, hey, rates will probably maybe bump once, higher for longer, and then start getting cut into the back half of 27. That would seem reasonable based on the way the Russell's acting. We're above all key reference points. We could take out some fibs because why not? If we come from here to here, fib 38.2 is over that previous left side high. What about the low? From here to here, in the neighborhood of this consolidation. I mean, there's plenty of room if the monthly chart pulls back on these small caps. This is the highest high. You could pull back. You could stage a monthly high or low somewhere in here. This is your last monthly high or low right there. So you probably don't want to be any deeper than, in a picture perfect world, it's this at, what is that, 270s? You'd like to see 270s be supportive on a monthly high or low, something in this neighborhood, but your line in the sand, fib 38.2 from this A to B move is a little bit deeper than that. Right? That is that one. There's, not as much to read into in terms of a major market crash on your IWM. I would just say mind the extension. That's the only thing I would caution on the extension from the 20 SMA here. As a matter of fact, are we at No, we can't even be close to that. Yeah, 61.8. But where's the 100% extension? 335s on the upside. If we continue to push there, think small cap biotechs. If biotech is going to take us home, then that's kind of the look. Let's take this one, though. Let's go from here to here to here. Where's that 100% extension? That's at 313s. Maybe we just wick into the 313s, then come back in. That's certainly a possibility. Let's drop this thing down to a weekly chart. Let's get a little bit more granular. Weekly bar here, a little bit more like the NASDAQ, honestly, with that larger upper wick, more of an inverted hammer versus the green-bodied bar in the S&P. It's a failed all-time high break. I'm not overly concerned by it. The Russell's been in an upward grinding channel for the last handful of months. For the most part, I think that this could pull back. You could stage like a red-bodied bar here. As long as you stack a weekly higher low relative to these higher lows, I wouldn't be all that concerned. And really, the ideal spot would be 287s. Right? If the weekly bar is red this upcoming week and looks something like that, that would be fine. I'd say lows, higher lows, higher lows, your upward channel remains intact. And then ideally, we're looking for back up towards the all-time highs. That would be the follow-up, right? So weekly chart looks fine. We could hit this with the fib. We just did this on the monthly, but there it is again. And then maybe we come in from this set of lows to this high, and there you have it, right in this neighborhood. 38.2, 50% retracement. That would be decent for some pullback support, higher low on the weeklies. Let's drop in our anchored VWAPs. On smalls, we're over this. Look at how these are just so respectful of the anchored VWAP. Each weekly low from this. I mean, just very, very clean stuff on the small caps. Upward channel is certainly intact. And for the sake of being congruent, let's hit the volume profile, see if we can just learn anything new. Very thin right up here as the grind just continues higher. It's not like volume's pooling up at any particular level. The ideal hold would just be over 280 from a volume perspective, noting the high volume node. Let's drop this thing down to a daily chart. Let's get into, I'll guess what we'll do. Sorry about that. I did miss the expected moves for the month of July on IWM. There you have it. 314.92 and 285.98 are the levels on the monthly expected move for July. Let's reset this back to a default drawing set. Let's talk about our weekly expected move first. Pretty compressed here, not expecting too much. Upper bound is a brand new all-time high, 303.98. Lower bound is 291.18. Slightly lower low underneath that ideal, if I just zoom out like this, prior top end of the range. Once again, this has been a very grindy, noisy uptrend. The market's not doing anything wrong. It's just not clean price action. I wouldn't try to trade this on small caps. I'm just using it as a tailwind for the S&P 500 primarily. So I don't even want to spend that much time on the analysis, right? Look above and fail. Maybe we just grind around in the range. As long as it does something like that for higher, no problem. If you start to lose this, right, this is where I'd say, okay, 280 is that key weekly. You don't really want to see anything deeper than that. Certainly would be a headwind to the broad marketplace overall if we start taking out this 292.50. So keep it simple. I'd just say watch this range right here. Over 299.50, bullish, inside neutral, under 292.50, more of a headwind for the market. That is about as simple as it can get. Really not much else to glean from the hourly chart. Again, this hourly lower high maybe is what puts the pressure on, and this is where I would start changing my tone under that 292.50. So keep it simple over here on your small caps. Let's jump on into the side of the Russell internals. Nothing major. You got a little bit closer to volume outflows on that Friday session. You did smash the zero line on the AD line, and this build did not get substantial. It did get about halfway there, though. This deserves a 2K read, and as of Thursday, it was down about 1,000 halfway there. So, small caps, they're not really much signal at this point. I would say the upward grind is a small tailwind, as I've said before, and if it does start to breach underneath this 20 SMA, we'll make note of it as a potential headwind. That's about as simple as we can make it over on the smalls. Let's rip through the sectors and see what's going on from a sector posture perspective. Who was leading, who was losing, and where was the weight? Mag 7, really nice rebound there, up 4.16%, followed by IGV software, up 4.16% as well. Financials, as we've said, right? Healthcare, discretionary, right? Pretty nice look in terms of risk on at the top of the list. Let's say RON for risk on. At the bottom of the barrel, it's over here. It's actually DRAM down 14.34%. That's your memory ETF. No good, especially as that relates to the AI trade. That is, dare I say, heavyweight, but it's important. It's been the backbone of the market, so to speak, on the top side. So of just semiconductors overall, this is more broadly speaking, not just memory, semiconductors down 3.7%. You could see XLE energy down 1.41%, and then technology all up down about 1.38%. generally speaking, it's a mixed bag. It's a very mixed bag. And to me, this makes sense as the market's kind of putting in this consolidation wedge, the weekly high tight flag, if you will, to see some churning of money. The most important thing that we want to make sure of in this market is that money is rotating from sector to sector and not just leaving the market all up, right? The most dangerous times in the market happen when it's sell everything. It's like, I don't want to buy healthcare. I don't want to buy consumer staples. I want to sell tech. I want to sell consumer staples. I want to sell utilities. I just want to sell everything. I want cash, cash, right? That's when the market will go straight down. We don't have that. We do have some degree of rotation happening right now. Mag 7 ETF, color me impressed, really impressed with the rally, just straight through the daily 200, trying to support above that. I'm trying to keep an open mind to a larger reversal. Show me the higher low, and maybe we're a bit more optimistic on the Mag 7 starting to have a rebound with Meta for hyperscalers saying what they said about the excess compute and selling it. Yeah, nice line item for revenue for Meta, but what does it mean in terms of all this CapEx maybe overdone? You got to show me the higher low. If there's a tradable higher low in here, then I'll try to get back on the bull train here, looking for optimistic outcomes and something that looks like that, but it's got to happen. For now, at face value, still just a lower high here and potential for this to keep the pressure right back on. So it needs more proof. Mag 7 ETF is really where I'm at on this. You've got an inside day Thursday. We'll get something early on in the week, I would hope, for either a wick that then just turns this into a flag, and then we have a potential, flag break there that gets us bullish, or if it breaks and comes in, you got to show me support here at this left side low, 63.20. Moving along to IGV. Nice rebound in IGV, but from my perspective, it's still just kind of a massive lower high after this rally attempt through here. I don't want to be overly bearish. Again, if it wants to show me the higher low like Mag 7, primarily over the top end of this prior balance at 88.10, I'll keep an open mind, but it does look like it went a little bit too far, too fast here off the lows. Inverted hammer failing on Thursday over the Wednesday high. Show me the pullback, gap fill reversal, and then maybe longs through 93.50. Or if we're here, show me the inverted hammer, inverted head and shoulders or something at this 88.10. Build the left head. Right, and we'll take it from there. Not a new money long immediately coming into the Monday session. Jumping over to the XLF, really strong stuff following up on that Wednesday break to the top side. This is great. I mean, this is going to mean what? You could either just get straight up continuation here for a measured move out of the bull flag into the all-time high, or if you pull back, you have plenty of room for a higher low over 54.50s to then establish a higher low and continuation of the trend. What do we know is coming up? It's going to be financial earnings. JP Morgan kicks things off about midway through July, not this week, but the week after that, I do believe. Double check me on that one. But XLF, financials as the second heaviest weight sector by market cap for the market, this looks pretty good. And once again, I know it might sound like a broken record, is going to be helpful for the S&P 500 not going down as much as the NASDAQ, right? The two index products can go down, but the S&P will go down less likely if financials remain strong. Here's healthcare, another one that will prevent the market from going down like sinking like a rock. Cup and handle breakout here through the all-time high, flat base high breakout. Just everything going for this on a new all-time high. Plenty of room to either get continuation or pull back, establish a higher low. We've talked about this XBI as well, where the risk on look is just a nice flat top base breakout and ripping to the top side. Advocate for new money longs here? Probably not. Ideally sets up some kind of a pullback. First flag, first touch, first something, and then you're higher on XBI and XLV. Let's go to the XLY. Just a noisy chart at this point. I want to give it some credit. Tesla had a really rough day on Friday. I want to give it credit for holding up in the range, not making a new low over here, but it's like there's no trend. There's no trend. Moving average spaghetti in the middle of this range. I need to see something more constructive before I have a stronger opinion. Which again, does that align with what we were thinking through on the NASDAQ? Yes, it does, right? XLB, lightest weight sector, middle-ish, upper half of this range. So constructive little higher lows. Maybe it breaks out. It's the lightest weight sector. It's not going to move the needle. It'll prevent an outright, or I shouldn't even say it will prevent an outright collapse, but it would be a sign that money's just still churning rather than coming out. Looking at industrials, looks like a flag here for potentially higher. Over the all-time high. Look at the look below and fail of the two-day equal lows on Thursday. So over 183 for consolidation and Brigade bolts up and outlook fine. Let's go to the XLC. This still looks pretty gnarly to me. To me, it's a lower high, right? I don't know in what world you could say that we're already back in an uptrend. A short-term uptrend on like a 15-minute chart, sure, but daily trend is still down. We have all of this overhead supply. This is not just a random level here at this 110.50. You could see the big upper wick on the Wednesday session. Yeah, you've got the hammer on Thursday. It's got to do a little bit more. I would not be afraid of like, okay, that's a short underneath the 2-day equal lows at 108.50. I would not be afraid of like, hey, a remount of 110.50 is a big deal. There's the potential for a long into the daily 50, and then we'll reevaluate. So could kind of see this going either way out of this 2-day range, but the dominant trend is down, and this still does look like a lower high to me. I would be partial to the downside. Let's go on over to this XLP staples. Middle-ish of the overall range. If you do this, right, you're sort of in that middle third. If we break into the upper third, maybe that is a bit of more of risk-off rotation, but still, once again, rotation prevents the market from going lower. Let's go on over this SMH. This is where the problems start to emerge. Broke the 20 SMA, broke through about 610. We had 611 up there. Just a little bit of rehashing on 610 there. If you bounce off the 50, that would be reasonable, but what's the threat now? I mean, my goodness, talk about your Man Ray pattern after a lower high. So that would be the problem on your SMH. Remember, the SMH has a history of like, oops, through the neckline and then you're back higher. So, although at face value, I think there are shorts to be had against 610 for something that rotates back to the neckline. If you're pressed into I guess my bottom line for the SMH is I would not advocate for being a short smack on the lowest low of this move. Why is that the case? Look no further than every other time it's ever offered you a head and shoulders. Whoops, sorry, didn't mean to trap you on the short side, right? Same thing happening over here. Like, oh my God, I'm shorting the lowest low. If that's kind of your head and shoulders, whoops, sorry, we're higher. And the most egregious one over here, you gapped down into the neckline, right? There's your head and shoulders. There's, the gap down into it. Oops, we're higher from there. So, the chart has told you every single time there's been a head and shoulders in the past, it has not ended well. Remember, patterns don't have predictive power. They just tell you where you're at in the trend count. And the bottom line here is being a short smack on the lows of semiconductors. I don't know. As much as maybe we're thinking, Meta's putting some pressure on this AI trade and it's no good. Is AI going away tomorrow? Is this whole thing going to come crashing down tomorrow? And, we've made this joke before, but is NVIDIA going to come out, Jensen, say, hey guys, gotcha. There's no such thing as Vera Rubin. We're not building out CPUs. Agentic AI, forget about that. I mean, that's not what's going to happen here. So, I think being short on the lowest low is a dangerous game to play for those semis. Here is the DRAM ETF really breaking down through this 66. No bueno on that front under the daily 20. Again, I don't know about, it's got no price history to it, so I wouldn't read into this too much, but just basic technicals would say, you set a lower high here, you're building the head and shoulders. It's probably shortable on a retest for a lower high against the daily 20, that 68.60 level, leaving that overhead gap unfilled. Let's drop this thing down into the XLE. Energy sector, nothing to really do or say or see over here. Look below and fail maybe, but nothing to write home about on that energy. Let's go on over to this XLK. You can see we've got ourselves a test of the daily 50 as we talked about in the NASDAQ, right? You have much cleaner range compression. Dare I even strike the trend line like that, right? You're in range compression. Do we support, noodle around, and then have an answer, midweek this upcoming or even after? It's a possibility, right? So I would just watch for this range compression to resolve. I can't be overly bearish here as we're above the 50. I can't be overly bullish as we're below the 20. I think we're just kind of caught between a rock and a hard place, and markets are balanced up there. If it's going to be more constructive, I think that's the obvious outcome over 186. We're just not there yet. And Thursday didn't really offer much of a concrete sign of strength, right? Let's go to real estate. Not much to comment on over here. Just been balanced for quite some time. I would think if market was expecting 2 rate hikes, we'd probably be here on real estate not happening. So another indication like small caps that Kevin Warsh might be a big old bluff in terms of like, oh, inflation's a choice and we got to get this down. Here's your XLU higher low. Here is your push higher. I mean, utilities are defensive. It's not doing anything wrong for markets, so I'd kind of let that be. As of right now, money is moving into financials. Money is moving into healthcare, and I would certainly say that obviously there's an exodus from your really high beta RAM stuff and semiconductors. It's pretty straightforward in terms of the rotation. Most people can see it at this point. We could also see it through the ratios on the screen. If you're not familiar with ratio charts on Thinkorswim, check out the video tutorial in the top right-hand corner. Look at your XLF coming to save the day for the market. I like that. Thank you, XLF. I would like to see better improvement out of XLC. I would like to see better improvement out of XLY, XLK. Did we set a new low right at it? If this breaks down, that would be a problem for the market. We'll pay very close attention to that next week. This is not good. That's defensive. This is not good. That's defensive, curling for a higher low. This is not good. That's defensive, curling for a higher low on utilities. Risk off is the look on the sector watch list. Let's go over here to the A set for risk on off. Didn't make a new low here yet. You did make a new low over here and you're back below it. That's not good. This has been problematic for a while. Notice the lower low coming in on semiconductors versus healthcare. It just looks risk off, right? It looks like muted markets, risk off, a little bit of rotation happening here. It's just we're not firing on all cylinders like we were through April, May, and even early stages of June, right? Let's go on over to the B set for our risk on, risk off. Gold not really sending any warning shots, but Bitcoin certainly with the recross back below the Sailor Shift tool under zero. And the TLT is just in a nice range flag here. I actually like that on the TLT, so I don't mind that. It still gives me a little bit more of a bias to say, S&P wise, probably a bit more bullish, right? If we go on over to this HG copper, the lower high here is a bit problematic. If this breaks down from a bear flag, that would be a risk off look from Dr. Copper. Let's jump on into the dollar and rates. The dollar did break down on that Wednesday session, get my days right here, but then it rallied back. Hang on a second. The dollar did print today. Okay, rallied here on the down day for the first, and then on the fall there, that is kind of your end of day bid, or if you will. Dollar, yeah, what's going? Sorry, I'm just trying to reacquaint myself with what day lines up to what on markets. Apologies. Spiders cash. This is the second. Okay, let's just think here. The second. Okay, lower dollar, and yet the market didn't really rally much. That's a little bit interesting under the idea that, a lower dollar should provide equity relief, and yet it didn't. Maybe because the market's still looking at this through the lens of a bull flag. That's what we talked about on Wednesday, that this bull flag, if it breaks, should be a headwind to markets. So I'm going to continue to maintain that stance. This looks like a higher low over the top of $100 on the dollar. If we look at the rates down here, 4.5 looks kind of like a breakout point to me, like that. I'd like to see lower. I'd like to see lower on rates. What we will say is that the crude not inventories, but the crude pricing has no more impact on markets. We're through the crude trade and the war, right? Obviously, we're lower here. We're back, not quite to the unaffected price, but we're certainly moving lower. A ton of overhead supply, and rates are just not acting sensitive to this at all. So I would stay away from crude and using that as a market internal at this point. Let's jump on into our inverted ZT to check in on the Fed Watch. Probably expecting no change on the Fed Watch tool. Let's jump into it. I'm going to give this a refresh to the probabilities tab. That way it is the latest data. I don't know if this refreshed in the background. There we go. So yeah, the singular hike is still priced for September. We'll watch out for that. No August meeting here from KW, but we will have a July meeting on the 29th. For now, it just looks like higher for longer. This is actually more aligned with what I believe the market should get instead of the additional hike out here and then cut and then pause, and then something like that. Let's jump on into the Forex factory calendar here, and let's just go back to where is last week. Here we are. Main idea, manufacturing PMIs come in kind of at expectations, no big deal there. And here's the big one. The earnings report. My brain's getting a little scrambled here. The non-farm payroll, let's lock in. The non-farm payroll comes in at 57,000 versus 114,000, and this prior gets revised down from 172,000 to 129,000, right? So that's a big revision to the downside. This is not an overcooked labor market where, oh my goodness, Warsh can be, really aggressive with rates because labor's doing just fine. The unemployment rate ticked down, but the hiring out there is not maybe as strong as originally intended, especially with this previous being revised down. If I hover my cursor, it should show up. Revised from 172,000. I don't know if you just saw in that little pop-up, but the market sold off on June 5th because it was scared that, oh my goodness, the labor report's way stronger than we thought. Warsh is going to be a stiff. He's keeping rates higher. He's hiking, as a matter of fact. And that's just not really what we got on the revisions here and this previous week's release. Let's go on over to, so remember, good news is bad news and bad news is good news, basically. We're in that current regime. Let's go on over this ISM Services PMI. Looking forward for the upcoming week. That is going to be a main event. That's on Monday morning at the 10 o'clock time frame, and then FOMC meeting minutes will be released on Wednesday at 2 o'clock. Aside from that, pretty quiet on the economic calendar front. Here is a deeper dive into the labor report. I just pulled this up because I thought it was interesting that the World Cup was being forecast as a huge influence on, artificially juicing the jobs numbers. Look at leisure and hospitality. It was actually down 61 there. So not really that as a situation. And instead, I think it's a bit more, dare I use the term accurate, but it's not that big ballooned number that I think most people were fearful of. Not sure why Earnings Whisper's given us the black calendar this week, but they maybe are switching up the colors. I think Peng could be interesting. I also really don't like, what are we doing here? They've moved the tickers to underneath the bottom of the, oh God. Peng Solutions, that's interesting. That chart's been incredibly strong. Something's up here with the earnings whispers. The interns on it this weekend. Peng Solutions is probably my top watch there. Of course, WD-40. How could I possibly forget? That is a huge market mover. WDFC. We'll be watching for that. And then, maybe Penguin Solutions on the side of it. That's it on the earnings calendar. Pretty quiet out there. No big updates. We're basically through earnings season, and we'll be waiting for the banks to kick us off in mid-July. Let's get into these additional supporting evidence charts, bond relationships. A little bit of an uptick happening over here. We did have some commentary from Fed speakers that inflation is not quite as tame as they'd like. So a bit of an uptick as the bonds respond to that. I don't think it's doing anything wrong though yet. If we look at credit spreads, they're still trending lower here with lower highs. This is a warning shot across the bow, but this is the one that matters most. We're not sort of broken yet. If we go to the HYG, for junk bonds, we did get this sort of sell here to make a lower low versus the higher low that's coming in on the S&P. With the dividend payout, it's hard to read into it too much. In the past, it's proven even with dividend payout that this is fairly accurate. But what have we been saying? It's been a better bottom finder in here than it has been a top caller. So I'm going to continue to maintain that stance. Let's jump into the breadth charts, and let's just go full screen on this guy and take a look. Breadth expanded into that Thursday session, so that's bullish technically. If you look at the RSP, brand new all-time high close. So how bearish can we really be? Once again, in the S&P 500 in particular, I am more of a bull there. I definitely think that your NASDAQ's going to be more sensitive. At this point in the analysis, we're just sort of checking the boxes of making sure that what I said earlier, makes sense. And there's no hidden oh my God, you didn't see that. And it's completely throwing off everything, right? I think this just validates the opinion so far on the S&P versus the NASDAQ. Here's your NASDAQ equal weight, kind of pulling back there, unlike the equal weight S&P. Let's go on over to our volatility index, lower, right? So that's bullish there. Let's go VVIX in the top pane without having to reset the chart pull, lower or unchanged even, and then we will pull our VIX futures here. Contango, decent one-day VIX. I don't really see any problems here through the supporting evidence, right? Nothing is derailing the thesis that we've set forth so far. Let's get into the core list of companies before those three additional trade ideas. NVIDIA looks okay in this little range here. I'd like to see some, either this to get into that gap above if we're going to have something interesting reemerge from the AI trade. I don't want to get involved through here. And if we do lose the daily 200, you're probably talking about lower, as that is confluence currently with the prior weekly range high. If I just zoom out, prior weekly range high. If you lose that, this is kind of a thin structure breakout, right? That's off the April lows. I would say under the daily 200 for something that goes like this could be a shortable opportunity. Let's go to the hourly chart to see that. Right, so the 200 will slowly kind of do this week. If we just do this, whoop, there you go. That is your short. Boom. Into that 184.25. Moving along into Apple, really incredible strength as the good old defensive tech into the end of last week. The idea here is that this just broke its series of potential lower highs, and instead now we watch, do we get this on a pullback over 300, the round figure? Does Apple reemerge as, hey, how funny, right? Apple, the one company that did not overspend on CapEx, didn't go out and build a bunch of data centers, didn't, sort of fall into that same trap, didn't really build out the AI narrative. Look how close it is to its all-time highs versus NVIDIA, versus Microsoft, right? All-time high is back here, versus Amazon, all-time high is back here. Just kind of funny, right? You look at it in hindsight, and you're like, wow, didn't spend on CapEx. They didn't grow as much through here, but, nonetheless, just kind of a interesting observation. So 300 pullbacks, right? Pullbacks to 300 for higher lows. If it really washes back below 300, yikes. I would say your short is game on underneath the prior all-time high loss. Underneath that level there, 288.65. Next up, Microsoft. Speaking of the AI CapEx build out, nice coming off the lows, probably due for a little bit of a pullback in here, retest that 380, show me the higher low, and then really be constructive on a reclaim of this from the range lows. Just a pretty gnarly false breakout over here, and it's got to reconstruct a base, a reconstructed low down here or something. Certainly starts to feel like this could be the situation, right, where we really start to remount and go from here. It's just got to prove it. And as long as we're over 380, I would maintain that stance. If this pullback goes deeper than 380, that's a short. If that's just back below 380, rejecting the 20, still below the 50, below the 200, trend is down. As much as I want to be bullish on Microsoft as a hyperscaler and a big heavyweight component for the Mag 7, under 380, this entire thing, that entire thesis kind of falls apart. So that's the line in the sand. Pretty simple. Amazon, I hate the location of the daily chart. Really, really noisy action this week through this range. So you got to show me this into the daily 50. Not interested. And if we break below the 200, that would be the short. So right in here underneath 230, 265s. Let's move on over to this Google. Google on a pretty linear pullback, if you do something that looks like that, it's organized pullback. Is it going to change character here on a higher low or a remount of the 20? I think it could. The chart and price action on Thursday didn't really do much compelling, I would say. It was just like noise. So I think it needs to firm up. It needs to offer a better setup. I don't see, this is not a setup here, but if we could do something near this 358 and reclaim it more firmly, this again, and then break some sort of equal highs or something, that would be interesting back to the top of this prior left side range. So that's Google. For now, just kind of one step at a time. Needs a higher low or some sort of a flag to form if it's going to be a long. If it's going to be a short, probably needs to fail back below this 344. Lows, highs, lows, right? Let's go on over this Broadcom, misclick, sorry. Broadcom looks weak. Custom ASICs narrative is out the window at this point. We overbuilt. We don't need all this stuff. Meta has excess compute. We're not using Broadcom anymore. Not necessarily the exact thing, but that's kind of the market's response, at least. This just looks heavy. This looks like a bear flag breakdown. This thing trades like garbage. It's the sixth heaviest weight component of the S&P, so we got to keep tabs on it. But loss of the daily 200, you just got thin structure to retrace. Looks ugly. This just looks naturally ugly. I guess this is maybe your saving grace prior weekly range highs. Maybe 350, 325, but I hate this chart. It's been elusive, sloppy, ugly, hard to get involved in. Option spreads are wide. It's just not good. If we look at this Meta, so much for that EP, huh? And instead, it the very next day, it broke down underneath 600. So we're not repricing the business. We don't care about this. Meta, agentic AI is not moving at the pace we want it to. Anybody who bought this thing in this range is like, I'm out of here for break even and sayonara. Nice knowing you. So I think it's a short. Any rally reattempts into this 600 are a short. We put the pressure on in here. Unless Zuckerberg comes out and says we're going to have another year of efficiency or something like that, I don't think the market is too fond of what's going on here with Meta. If it was going to be strong, you needed to hold an inside day on Thursday. You needed to start building out towards the top 50% of that range from Wednesday's gap, and then possibly started to reclaim the 200. It's just not at all how that unfolded, right? This was just pretty instantly lower and losing that 600. So in my view, lower highs in here, and then we start to get the H pattern, and then we're just shorting into this gap for potential thin structure retracement, right? Let's jump on over to this MU, lose the 20, show me the money. There it is. So breaking the 20, breaking a prior day low, and closing pretty heavy. I think that, as we talked about in the intro, MU, the last time it broke the 20 SMA, it fell 25% from here. Not to say that it has to do the same thing. Please don't misunderstand what I'm saying. But if it falls 25%, that's going to close this gap down here, which actually, the more I look at it, that's two really bad days in MU. That's totally within the bounds of possibility. So as of right now, as it stands, I would say this lower high is your problem at 1,013. If you reject this overhead supply, that is bearish. This is a lower high. This keeps the pressure on. You're under 1,000 at that point. You're targeting this gap close to the downside. If you remount this area, I would want to see the good above, bad below level reclaimed, which is this left side peak at 1087.50. That's it. So in here on MU, no thanks. In here, shorts towards the gap, over the top, longs towards the back to the highs, right? That's it. That is it on MU. Tesla, what a just abysmal chart from okay, nice. I thought it was, it looked like a short. We talked about this on Friday. I think somebody quote tweeted it as well. We were like, yeah, it looks like a short headed into Thursday, but not a short for 8% into the middle of the range. I was like, okay, a short maybe to the 50. This thing is brutalized. So much for this change in character and wow, wall-to-wall move. Show me the flag up here and maybe Tesla gets back on its high horse and starts moving like Tesla used to. Just forget about it. So really thin structure in that range. Let's go down into this hourly chart. If this rallies and rejects the daily 50, that's probably a short, right? Just to see this move completely fizzle and fall apart after the delivery numbers gave it an open that was still in range on that Thursday morning session, that's brutal. That's really, really ugly. So any kind of lower highs up against the daily 50, probably shortable back to range low, then we'll figure out where we go from there. If Tesla is just like this and then this, pretty wild chart. So Tesla needs to show me something, needs to show a respectful lower high. I would look for it there. If it pulls back and supports in here and just grinds in the range, we'll just wait for earnings until this chart wants to play nice again. JP Morgan earnings further out, 14th. We'll see if this can go head and shoulders and offer a weekly pullback to this. That would be fine for here, or you just flag out and continue. That would also be fine. I don't really want to trade JP Morgan, but for financials, it does look great. If we look at AMD, parked itself right on the 20 SMA. Let's see if we can get a look below and fail. on AMD for something that looks like that. That is the primary look I'm going for on AMD. If you lose the 20 and you Brigade bolt lower high underneath, I think you go kiss the 50. That would be pretty unnatural. So first thought is that you've got a failed breakout to the all-time high. You come back into range, you get the full range rotation. Let's see if we can't go look below and fail. Stay in the balance range, higher tight consolidation in the upper 50%, then go. If the market does Brigade bolt underneath and is unable to remount, retake that 507, recapture, that's where we're thinking about the daily 50. So 507, the key level, very obvious, very nice balance range here on AMD. We'll see what we get. Intel, had to let this go, let it go for profit, but just not really acting the way I want it to act. The market doesn't care what I want. We all know that, right? So it's not acting the way a high tight flag really should. If it was going to, it should have been kind of clean up here, started to get going, keeps consolidation to 50% of the daily bull flag, and then we're really ramping into this next week. Obviously, break the 20, no good there, park itself back on this equal low. Had to let this thing go on the break of the second half in here, but I let go of the first half in there at 130.50. So not, the end of the world with an average at 116. It's, basically a break even. But anyway, not to lament on our darling. What is up next for Intel? What's really been great about it, and by the way, let me just reflect on this for a moment, maybe even if it's selfishly for myself. That's what selfish means, Matt. It's offered some really beautiful day trading opportunities in here. So the options trades that have been had on top of the Intel swing trade have just been really phenomenal. So thank you, Intel, for finding yourself into our universe and making a home on the core list of companies. So what's next? Sentimental pieces aside, it looks like a failed breakout. It looks like a lower high sub 130.50 puts the pressure on. Under the equal lows, you lose the daily 50. Do you have to go all the way to the high tight flag lows? Probably, right? And then we'll sort of get the next tidbit of information on earnings. If this shakes everybody out under the 50, can do this. Is that still a weekly higher low? Yes. I would look for a constructive daily chart pattern if there's going to be some reason to add this back through 130.50, right? If you shake out the 50 SMA and then set daily higher lows through here and then Brigade bolt above 130.50, retaking that left side peak, I'm not just going to sit here and say Intel didn't at least, try to give it again. So I'll try it one more time if it wants to set up and there's a way to manage risk. It's not like Intel's just going to fall off the face of the earth and not, be this irrelevant stock now that the one high tight flag didn't work out. So that is kind of the look on this one for INTC. Let's jump into the additional ideas. First one's on CrowdStrike. I think CrowdStrike's interesting here as a double top short. Not that, we always say a double top is a double top when it is, which is down here. But I think you're coming into resistance and this has a failed breakout through that previous left side high. And you've set a bearish engulfing. Come on, why is this not? Is it me? It must be me, user error. This 196, let's call it. If we can stay opening inside of this range on Monday's open, Brigade bolt underneath the Thursday low. Let's go to the hourly chart and let's find that level. It's here, 191.25. Sorry for not doing all of my homework here on the long weekend, but let's do that. You do that, you're probably talking about thin structure retracement. I am long pan W, so I'm not rooting for the I'm long pan W from here. I'm not rooting for the cybersecurity trade to fall apart. I just think that this CrowdStrike is showing a tight enough entry for risk reward to the downside for a thin structure retracement. That's all I'm saying on CrowdStrike. Next up, Rocket Lab. I think Rocket Lab is a short on a lower high against the declining 20-day moving average in here. You got back-to-back inverted hammers. You got that to set up. So if we could just get an H pattern to build out on Rocket Lab, that would be great. If we stay over about $100 in here, if we don't take out the 2-day equal lows, I would just let it rebuild. And then maybe we even flip the script and say inverted head and shoulders. And then we're looking for higher, right? And maybe space continues to run. Why am I not fond of that? Look at your SpaceX. Kind of a brutal day there on Wednesday. Just not really going anywhere fast. Like it just kind of unwound this entire thing, right? And the SpaceX hype is no longer there. Not to say that Rocket Lab is a bad company. I'm not sitting here talking about the fundamentals, I'm talking about the technical setup of a lower high after too far, too fast, retracement, lower high dead cat bounce, go back to the equal low, right? That's about as far as my brain goes. Anything above that is above my pay grade to start talking fundamentals. So that's Rocket Lab. Next up is Reddit, RDDT. Chart looks great for a long. You've got like a base that's formed down here. This was really nice under the notion that you had these weekly higher lows. Now you just have this inside bar on Thursday. I mean, relative to what the broad market did, that's very strong on this Reddit. So you've reclaimed the daily 200, big momentum burst to the upside there, resting inside day on Thursday, up and over the highs, or just continuing a day or two sideways, shake this level out one more time, and then higher could be the idea on Reddit. And the target would be this gap close to start. And then beyond that, you're talking about further up. Let's just label some of this stuff. Again, thanks for bearing with me as I do some of my homework with you guys here on the actual analysis video itself. Headed into the long weekend. Get the job done early. All right, so that's that on your Reddit, and that is the third and final trade idea. Again, I just thought notable relative strength on that Thursday session, especially after a big leg up and out of just kind of a constructive base down here on Reddit. They've got the data, right? They've got the data. So with that being said, have yourself a green and fantastic trading week ahead. Obviously, this video is coming out on a Friday, July 3rd. So happy July 4th to all of my fellow compatriots here in the US. Hopefully you show back up to the desk on Monday with all 10 fingers. Remember, you've got to throw the firework once you light it. So please, no blown off fingers. You got to be able to click the mouse. Have yourself an awesome weekend. Try not to think too hard about markets. Enjoy the time off. Enjoy the time with friends, families, loved ones, anybody that you've got in your circle. Spend some time off the screens. And as always, we'll be back at it on Monday for another episode and installation of the pre-market prep. We'll see you back here at the channel at 8 a.m. Eastern time, kicking things off, getting the job done, building a game plan for the day ahead. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Have a green trading week. And as always, I will see you in the next one.